Hello guys, welcome to Formulating Finance. In our channel, we discuss everything related to finance and also the practical aspects about how some of the concepts are applied in real life. In this video, we are going to understand about real estate investment trust. Let's first look at real estate. We all know about how lucrative real estate investments are because of increase in market value of the property over time plus the rental earnings. But what next comes to our mind is the immense amount of money required to own that asset plus longer horizon, handling legal procedures and sometimes even losing the higher value due to bad economic phases. To counter this, in 1960s in US, a concept of REIT was originated because of two factors. First, pool of immense capital to invest in A-grade properties. Second, securing liquidity. In context of this, now let's understand REITs in detail. REIT stands for Real Estate Investment Trust. A REIT is a trust that owns, operates, or finances income producing real estate. REIT is just like a mutual fund, wherein retail investors or institutional investors can buy units and can enjoy being a part of ownership of A-grade commercial and residential properties. To be able to retain tax enjoyment entitlements, REITs have to distribute their 90% of the income earned during the year to its unit holders. REITs can be exchanged on the stock market just like equity shares. And just like mutual funds, REITs has sponsors, trustees, fund managers, and unit holders. Investors enjoy appreciation of property's market value plus earn rental yields in the form of dividends. REITs as a product that provides liquidity. Large volumes are traded each day. Transparency, as it is listed on stock exchange, all the regulatory work is at place. Diversification, portfolio is diversified across commercial, residential buildings, solar parks, warehouses, hotels, offices, etc. REITs can be of three types. First, equity REITs that typically own, operate, and to a limited extent develop income producing real estate property. Second, mortgage REITs. Mortgage REITs invest the bulk, typically 75% or more of their assets in interest bearing mortgages, mortgage securities, or short term loans secured by real estate. Third, hybrid REITs. These are the mixture of equity REITs and mortgage REITs. Different structure of REITs. First, hotel REITs. Hotel REITs typically lease all their properties to taxable REIT subsidiaries or to a third party who operate them, and the management of the hotel is usually turned over to hotel management companies, many of which own widely recognized hotel brands. Second, industrial REITs. Industrial REITs hold portfolios of single tenant or multi tenant industrial properties that are used as warehouses, distribution centers, light manufacturing facilities, or small office. Fifth, healthcare REITs invest in skilled nursing facilities, nursing homes, assisted living, and independent residential facilities for retired persons, hospitals, medical office buildings, etc. Health REITs turn this over to healthcare providers to manage these estates. Sixth, office REITs. Office REITs invest in and manage multi-tenant office properties in central business districts of cities and suburban markets. Lease terms are typically long, 5 to 25 years. Lastly, diversified REITs own and operate in more than one type of property. It can be a mixture of any of the style of REITs as mentioned above. One such REIT trading on NSE is Embassy Office Park REITs. It has a portfolio of 7 A-grade office parks in metro cities. More information can be found on the website of such REITs, but some of the financial metrics are 14% year-on-year growth in revenue from operations, 15% year-on-year growth in net operating income, plus rupees 24.39 per unit were distributed in FY 2020. Thank you for watching the video. Like, share, and subscribe to my channel, and please give your feedback in the comments. Thank you, guys.